The argument for direct recognition versus non-direct recognition companies seems to be as intense as most presidential debates. Well, in this video, I'm going to end this debate once and for all. Now, just in case you're new to the subject, let's start with the basics. And let's even discuss what direct recognition and non-direct recognition even mean. And even before we go there, let's dummy it down one more notch. You have two separate types of companies. You have a mutual company and a stock company. The easiest way to think about a stock company is like Apple. Apple is on the New York Stock Exchange. They have investors, and those investors are shareholders. The company has a fiduciary responsibility to put the stockholders first. Therefore, the dividends and the profits go to the shareholders. Now, let's talk about the good stuff. A mutual company is a private company that is owned by its policyholders. So when you get a policy with a whole life mutual carrier, you become an owner of that company. By being an owner of the company, they pay you a dividend. Now here's the kicker. The fiduciary duty of the mutual company is to pay out all the profits in the form of a dividend to you. Which then brings us all the way back around to what is direct recognition and non-direct recognition company. It is essentially two different strategies that these insurance companies use to pay out a dividend. Strategy numero uno, non-direct recognition. Paying the same dividend to the policyholder regardless if they have an outstanding loan or not. This is promoted as king of strategies by most insurance agents. Let's take a look at an example. You have $100K in cash value. Of this $100K in cash value, you have a $20,000 loan. Both the $100,000 of cash value and the $20,000 loan are both getting a 6% dividend that is applied. Strategy 2, direct recognition. Paying a slightly different dividend and an increase or decrease of a dividend only on the amount they have a loan against their policy. Example, $100,000 cash value. There's a $20,000 loan against that $100,000 cash value. We're going to use a 6% dividend. The $80,000 that has no loan is going to get applied a 6% dividend. That $20,000 that has an outstanding balance for a policy loan, the dividend is going to change with a slight increase or a slight decrease. So you may be asking the question, why are there even two different approaches? Well, that's a great question. I am glad you asked. Before 1982, every single insurance company was a non-direct recognition company, but there was one problem. The rising interest rate environment was becoming problematic. In the early 80s, Moody's bond index and treasuries were greater than 14%. The reason the high interest rate environment was so problematic, your premium goes into the insurance company's general account, which is essentially their big bank account. From this account, they take your dollars and they go invest it. Those funds in the general account are also used to pay out policy loans to the policy holders. So when they give you a policy loan, they can no longer go invest those dollars. So let's look at an example. You pay $100 and it goes into their general fund. They take your $100 and they go invest it. Let's say they are earning 10% on your $100. Therefore, they made $10. Of the $10, they pay you a dividend. Let's say the dividend is 8%. So they paid you $8, allowing for a surplus of $2. Now let's look at another example. You pay $100 and it goes in the general fund. Let's say that $100 is now being loaned out to you. The loan rate is at 6% because they lent you the money, they can't invest it, so instead of them making 10%, they now only made 6%. So in this scenario, they made $6. If the dividend is still at 8% and they pay you $8 and they only made $6, they now have a negative balance of $2. So what does the insurance company have to do? They now have to bring the dividend way down to compensate for the deficit. So to combat this problem, along came a company named Guardian. And like all companies, they did what they should do, is they innovated. Thus, direct recognition was born. With a direct recognition company, let's look at an example. If you pay $100, it goes into the general account. Let's say the $100 was given to the policyholders in the form of a loan. The $100 that was paid to the policyholders, the dividend would adjust to roughly 5.5%. This allows the overall dividend to stay at 8% for non-loaned out money. Quick note, direct recognition dividends adjust roughly equal to the same percentage as the loan rate that was borrowed. So long story short, there's no such thing as a free lunch, unless you were me in elementary school. So essentially you have two options. Option A, you have a non-direct carrier where your dividend is not affected when taking out a policy loan. But if a company has a high percentage of policy loans in their general fund, the dividend will likely be smaller, affecting everyone, including people who are not taking loans. Option B, you have a direct recognition company and the dividend will likely be higher, but when you take a loan, your dividend will change on the loaned amount. So you ask, which one is superior? Well, in my humble pie opinion, and when you talk to really smart people, and I mean really smart people, and not just agents who have not necessarily broken down the math, and just assume non-direct recognition loans are better, it's a draw. I know, it's like kissing your sister, right? Honestly, a priority of things that should be on your list when looking to buy a whole life insurance policy, this should be last on the list. This should be at the very bottom of the totem pole, even though some agents make it first. Most important things are the company's reputation, is the policy designed properly, and how are you going to use the policy? Another quick note, the one time that I'd argue that non-direct recognition loans could be better, if you were to 100% of the time be fully leveraged all the time, is if you were to 100% of the time have a max policy loan and were to never pay the policy loan back. But this would break every single rule that even Nelson Nash and Maximus Infinite Bankers would say, is they are even advocates for paying your policy loan back. If you use this strategy right, there will be times where you don't have a max loan out, or you're funneling your money back through the policy, thus paying back the loan. Lastly, if this video wasn't already long enough, I am going to break down the numbers. I'm going to show you two companies, one direct recognition company and one non-direct recognition, because I want this to be the last time you have to watch a video on this subject. So let's go ahead and take a look at the numbers. We're going to take a look at two separate policies. One is going to be a direct recognition company, and the other one is going to be a non-direct recognition company. I have designed both of these policies for optimal efficiency. The direct recognition company is going to be a 15% base, 85% PUA, and the non-direct recognition company is going to be a 10% base with a 90% PUA. So let's go ahead and look at the numbers and compare. Year one, this is a direct recognition company, $100,000 going into the policy, $80,000 of cash value. The non-direct recognition company, there's $100,000 going into the policy, there's $90,000 of cash value. So right off the bat, you have about $10,000 more with the direct versus non-direct. Year five, $501,000 of cash value. We've put in 500, means the break-even point on this policy is year 5 as well. So the break-even point on the non-direct recognition company, $500,000, $513,000 year 5. The break-even point is also year 5 on this policy. Break-even essentially means I have more cash than the money that I put into the policy. We start looking at this policy year long term. We look at year 20. You see there's $2.9 million. With the direct recognition company, there's going to be a total of $3.2 million. So at some point in time, the direct recognition company passed and outpaced the non-direct recognition company. Now, here's what I'll say about that. Not all policies and all companies are created equal. So what we want to do is we want to pick the best companies and we want to optimize it for optimal efficiency. Now, every company is going to be slightly different. Some companies may optimize for higher cash value earlier. Some companies may optimize for higher cash value later. Some companies may have a stronger dividend. Some companies have different loan rates. Some companies may have a stronger death benefit performance. Every company is going to be different, which is why it is super important that we take a look at the numbers and dial back the onion and not say, let's look at direct versus non-direct, and let's actually take a peek underneath the hood and let's actually figure out what is going on. So what we're going to do next is we're going to actually take a policy loan from both companies. We're going to take a policy loan from a non-direct recognition company, and then we're going to take a policy loan from a direct recognition company, and we're going to see how that affected the cash value. So first, we're going to look at the non-direct recognition company because it's going to make things simple. So non-direct recognition company, looking at a loan, we're going to see a $20,000 loan, and I am using this as the examples from earlier in the video. So we're going to use the same example. You have $100,000 of cash value. You have a $20,000 policy loan. Of that $20,000 policy loan, it is going to get the same dividend rate as the full $100,000. So what you'll see here is that $100,000 was put in every single year. Of that $100,000, $20,000 is being taken out, quote unquote, borrowed against. It's not actually being taken out. That full 100,000, this 80,000, and this 20,000 are getting the full dividend rate applied. Now, in reality, what's really going on is this full 1.1 million is actually getting the full dividend amount. Okay, I just wanted to use that as an example, like I was using in the previous video, to give some comparison. Now, when we come back into 10 years later from when we take a policy loan, $20,000 policy loan, year 45, age 45, year 10, we will see that there's interest charged. This current policy is accruing a 5.7 interest charge at a 10 for over, a 10-year window. After 10 years, there's a total of $34,816. Make that loan payment back, you'll see that age 55, year 20, it's $134,816 going in, which is a $100,000 payment and also our $34,000 loan payback. So when we look at that, what is our total cash value? Our total cash value after making the policy loan back, $2,970,510. We look at the policy without the loan, $2,970,510. The same exact number. So it just proves the point that when you take a loan on a non-direct recognition company, the cash value does not change. Now let's take a peek at the direct recognition company real quick. So direct recognition company taking a loan, same year, same everything, age 45, year 10, $20,000 loan. This direct recognition company current loan rate is at 4%. So 4% over the next 10 years, we're essentially paying the loan back after, at the 10th year at age 55, year 20. See that there's a $29,605 total of principal and loan interest that has been tacked onto this. You'll see here our total payment out of pocket is $100,000 for our contribution, plus another $29,605 on top of the loan repay back and also the interest on top of that. So you'll see, looking at the two between the non-direct recognition and the direct recognition, right off the bat, there was actually a $6,000 difference, $5,000 difference in regards to how much was being charged from an interest and also from the total loan principal. So that's something you have to consider. What is the loan rate with the company? Now, these companies are currently they're all at a variable loan rate for the most part. And so the loan rate is going to be different from when I'm taking this video to when you watch this video and to 1 year from now. So I'm not going to give exact loan rates on company specific. Just know that this one's at 4% and that the other one was at 5.7%. So when we make the payment back, what is our total cash value? Our total cash value is $3,276,000. What was the cash value before we took a loan? The total cash value was $3,282,000. So you can see that there is a difference of about $6,000 difference when I took a policy loan from when I didn't take a policy loan. The reason is because you have $100,000 of cash value. Of that $100,000 of cash value, you're taking a $20,000 loan. That $20,000 loan adjusted on the amount of dividend that is going to that $20,000. The other $80,000 did not change and kept the same interest rate, which is the same example that I used earlier in the video. So looking at the numbers, the end all be all, every company is going to be different. Every company has its own uniqueness in regards to policy performance, longevity, dividend history. They have their own uniqueness into higher cash value earlier on, higher performance later on. It really all varies. So there's no one winner at the end of the day in regards to, is one better than the other? You could argue that the direct recognition is better in this scenario. You could argue that a non-direct recognition company, if you're looking for higher cash value performance in year one, would be better than the other scenario. But I'm not even going to constitute it as a direct versus non-direct. I'm constituted as that's just the company. I can pull up another illustration that will show a direct recognition have a higher cash value in year one than this. And I can also do vice versa, where I can have a really strong performance in the later years with the non-direct recognition company as well. Anyways, I hope this helps. Please subscribe, and until next time.